Hi guys, my name is Nicolette Mashile. I am also known as the Financial Bunny. Welcome to the Financial Bunny TV. Today we're talking all things ETFs, exchange traded funds versus buying individual stocks. But remember that none of my videos constitute as financial advice. If you are looking for financial advice, please speak to somebody that is certified and registered with the FSCA to give you the financial advice that you need. So let's talk a little bit about why we're even talking about this, right? So if you are somebody that is looking to allocate some money to the stock market as part of your asset allocation strategy in terms of putting together a great investment portfolio, it means you need to understand where to actually put your money. Now, there are different financial instruments that are within the stock market that you can use. One of those is called an ETF. Alternatively, you can get a unit trust, a mutual fund, a REIT. There's various financial instruments. But today, I want us to look at the ETF in comparison to buying individual stocks. So let's start off with, what does the acronym ETF stand for? It stands for Exchange Traded Fund. So I want to take it a couple of steps back and maybe explain what investing in the stock market actually is. So I want you to imagine this fist of mine as a company. We're going to call this company Financial Bunny, right? Financial Fitness Bunnies. Financial Bunnies want to expand into, let's say, the rest of Africa. So we want to have an office in each of the African countries. We want to open the Financial Bunny School. However, we don't have the capital to be able to do that. So we then decide, you know what, let us issue some ordinary shares that the public is going to have access to, and they can buy these ordinary shares. Now, of course, one, we need to be listed on the Johannesburg Stock Exchange for the public to be able to transact or buy our shares, right? There are other alternative stock markets, and you can actually invest and buy equity into private companies. However, today we're talking about publicly listed companies on the Johannesburg Stock Exchange or any other public stock exchange, right? So Financial Bunnies is listed on the JSE. It is issuing a number of shares, ordinary shares, that the public can buy into. We want to raise money to be able to expand into the rest of Africa. According to the valuation of the company, we will then come out with a share price. So let's say a share is going to be 10 Rand for one share. I wish that would be my listing price. I wish, right? So let's say it is 10 Rand, right? If you want to buy stock, you would then go and buy stock into the Financial Bunnies, and you can buy as an individual stock, right? But what does that actually mean? Let's say, for instance, maybe you buy yourself 100 Rands worth of Financial Bunny stock, so you're going to buy 10 shares. We then sell all of the ordinary shares, and we've got a various amounts of people from different corners of the world who are now shareholders in our company, Financial Bunnies. Then we try to expand into the African market. We try to open these schools, but people are just not biting, and we're just not expanding well, and we're not doing well, and our share price keeps tanking and tanking and tanking. And then we think, oh, let's find a quick safe strategy, and we hire a random person who's got so much drama behind them, and we think maybe this person is going to be great for the company because they come with expertise, but we forget that they may have a little bit of drama somewhere behind, and they tank the share price even worse. Now, what essentially is going to happen, let's say for instance the share price then drops to 1 Rand a share. That means that the value of your portfolio would have moved from 100 Rand to 10 Rand, because remember, you've got 10 shares that you have bought, whereas you bought them at 10 Rand. Now they would have been 100 Rand in terms of value, because that's how much a share was. It was 10 Rand. Now, if the share price drops to 1 Rand, which is quite dramatic, right? It drops to 1 Rand. It means that the value of your portfolio is now 10 Rand. Now, of course, you're not really realizing the loss yet. However, it will take a long time for that share price to recover, right? You only realize the loss if you actually sell or you transact, and it's like literally hitting the coffin onto the nail if you do sell those shares at that price, right? Now, we've seen some dramatic drops. We saw it with Steinhoff. We saw it with, I think it was Sasol during the COVID-19 lockdown period. We've seen some dramatic share droppings on the Johannesburg Stock Exchange. So it actually can happen. And that's the huge risk that you carry when you buy individual stocks. It means that you are saying, I believe so much in this company. I believe so much in this company that I think that the share price will gradually grow. And if it drops slightly, but it will grow. So there's a huge big risk that you're taking. So then what would then be the alternative? And that is why we're talking about ETFs, the exchange traded fund today, because that's an alternative financial instrument to buying individual shares. And the example that I'm going to be using is that of the Satrix Top 40. I know it's the easiest one, so of course I'm really just going for all of the wins, right? Now let's talk a little bit about why an ETF. An ETF's performance is predicated on the idea of diversification. Why do we say this? Let's take the Satrix Top 40, right? The Satrix Top 40 is an ETF that tracks the index of the top performing companies, the 40 top performing companies on the Johannesburg Stock Exchange. So if you take 40 companies and then you talk a little bit about the risk that goes with them, it may seem like the risk is big. However, whatever amount of money you are going to use to be able to buy into the ETF, it means that you are taking that money and you're basically spreading it across 40 different shares. In other words, the risk also spreads. Does that make sense? So when you buy into this ETF, you are essentially getting exposure into 40 different shares as opposed to if you are getting one share. I want to give you a better example that actually explains what an ETF actually is, right? I always say an ETF basically is like having a salad. So let's say in your salad, you've got biltong bits, you've got some lettuce, you've got some green leaves, you've got things like your feta cheese, you've got your croutons, you've got your cherry tomatoes. And every single day, this is the salad that you are presenting to everybody. And based on the prices of these different ingredients within your salad, you then have a price for the salad itself. But now let's say, for instance, cherry tomato season is kind of teka-teka-ring there. The cherries that you are getting are a little bit smaller than usual. And now the price of the cherry tomato is dropping. It means that you are only going to feel the risk of the price of cherry tomatoes declining just a little bit, because remember, your risk is spread across the biltong bits, the green leaves, the biltong that you've got in there, the croutons, the feta cheese, all of the ingredients that are in there. So you're not going to feel the wrath of the dropping price of the cherry tomatoes all on its own, because the other ingredients are going to carry the cherry tomato to make sure that you still have a favorable ETF. Now, it is also important to remember that unlike the unit trust, the ETF behaves the same way as an individual stock. So that also then shows you that there is a little bit of a risk that is also attached to the ETF, because it actually fluctuates throughout the day. Unlike an instrument where it's got an opening price and a closing price, the ETF, just like a share price, is fluctuating throughout the day as the fluctuations happen within the actual ETF from the individual stocks themselves. So you may find that the cherry tomatoes in the beginning of the day have dropped in share price, but at the end of the day, they have picked up and they've actually helped the ETF perform a little bit better. So that's basically what the ETF is. Now, people ask this question, are ETFs better than individual stocks? Look, from a diversification level, yes. From a risk level, perhaps. However, you may find that a fund manager has put together an ETF that is aggressive, an ETF that is perhaps maybe tracking an index of small cap fintech companies that are new to the market, or industries that are extremely volatile, like the mining industry. You may find that buying a different industry type of individual shares. So for instance, maybe you're looking at the banking sector in South Africa, and those 4 banks that are listed, your Standard Bank, your Nedbank, those banks that are listed on the stock exchange, you may find that buying those shares may not give you huge performance and return, but they are stable. And they are far better in terms of risk profiling versus you buying an ETF that tracks the mining stocks index, for instance. So again, it's really about looking at what is inside your actual ETF. That will also determine the risk that you are actually exposing yourself to. So remember that an ETF can be made up of different types of asset classes. Sometimes it's asset classes from an individual perspective, and sometimes it's asset classes from a mutual fund perspective. So you may find equity funds in there, you may find real estate funds in there, you may find currency funds in there, commodity funds in there, fixed income funds in there, specialty funds in there. So it's just a mix of different types of funds that you are able to find within the ETF, or the ETF itself may look at different types of indices that it's going to be actually tracking. So you can find different ones. And remember, it's also important to remember that if you are going to be investing in an ETF, they are actually registered in South Africa. If you cannot find a registration number for your ETF, it means that it is not a valid ETF in the country. In actual fact, it may just be an illegal ETF. So make sure that before you invest in an ETF, you check whether or not it is registered. Also, it will go a long way for you to find the fund fact sheet of that ETF, so you can give yourself a better understanding of what exactly are you actually investing in, who are these people that are behind and managing the actual ETF. Because remember, going into the advantages of an ETF, one, the biggest thing is diversification, but two, you can actually trade ETFs daily. So it is important for you to know who is this manager who's got their eagle eye on this fund that you are investing in. Of course, the disadvantages many people will always put on the table is the fact that some ETFs do or attract a very high risk because they are tracking a very aggressive index. And then the other one is that sometimes the rate of return is quite low because of that diversification that is actually happening within that ETF. I'm hoping that I've helped you in kind of getting a better understanding of the difference between ETFs or individual stocks when you want to include the stock market as part of your asset allocation.